for chapter 11, and then what we'll do is we'll try to do the homework questions together. I think probably if we go over everything and nobody has any questions, we probably will leave early again today. But I will stay until the very end of class. So that seemed to work well last time. Some people wanted to stay and ask questions about the homework or about the class or anything else. So we can do that again today. Okay, if you look at the chapter 11 materials on Canvas, we have the lecture notes. So after class today, I will post the completed filled in lecture notes. But let's review what we talked about last time. Last time we talked about responsibility accounting. So responsibility accounting is this idea that if you have an organization that's decentralized, right? A decentralized organization is where you have different departments. There's good and bad things about that. So here, as we can see, with decentralization, you have, for example, Department A, B, C, and D. Okay, so we have Department A, Department B, Department C. So these individual departments operate on their own. So they're going to generate typically their own revenue and their own costs. If that's the case, then it's called a profit center. Okay, so generally, departments within an organization operate as a cost center or profit center. Profit center. So profit center is the most common form of organization for departments. That's when departments are responsible for their revenues and costs. Okay. So most of the time when you have different departments, they're responsible for making their own money. They're responsible for managing their own costs. And that's what we call a profit center. With decentralization, there's a lot of different advantages and disadvantages. So we can go ahead and look at these advantages again. For the advantages, one of them is that if you allow people to make decisions at lower levels, typically they have hands-on information or they have hands-on experience. For example, if you have a hotel, maybe somebody who's working the front desk is dealing with a customer or a hotel guest, they're able to make a better decision on whether the customer should get a free night at the hotel, or if a customer has some type of complaint, how best to solve that complaint, because they are actually at that level of the decision-making process. So typically, we say that one of the benefits of a decentralized form of organization is this access to better information. In addition to access to better information, you can see that managers are going to be able to get more decision-making experience if you're willing to delegate and have a decentralized form of organization. Remember, decentralization is where communication is more flat and decision-making is diffused throughout the organization. So instead of having to clear everything with the top person, people at different levels of the organization can communicate with one another and make decisions. This is good because it allows top management to focus on overall strategy, and lower level employees can focus on day-to-day operations. Right? Additionally, we can see here that with a decentralized form of organization, lower level managers typically are the ones who are able to respond to customers the fastest. Right? So with the example of a hotel, a customer comes in and they have a complaint or they have a grievance. Well, the person at the front desk is able to respond to the customer in the fastest manner, instead of saying, for example, well, let me get back to you. Let me talk to the manager or the big boss. Okay. And typically, if you empower people, then it's going to lead to more job satisfaction. Okay. This is also called theory Y level of management. Okay, so, or a style of management. That means it's more participative in nature. Okay, so theory Y means it's more participative in nature.
Nó không như accounting đâu chị ơi.
Oh, can you mute, please? Okay, thank you. Okay, okay. So disadvantage is lack of coordination. Okay, so lack of coordination means, as we said last time, everybody is trying to maximize the profits of their own department, Okay, so if everybody tries to maximize their own department's profits, then they might do so at the expense of other departments or at the expense of the organization as a whole. So really, the disadvantage of having a decentralized form of organization is this idea of lack of goal congruence, right? So goal congruence means that if I look after my own interests and you look after your own interests, somehow the organization should be better off for that, right? So how do we promote goal congruence? Okay. This last disadvantage is also important to keep in mind. So with decentralized organizations, sometimes if you have a good way of doing something, it's hard to get everybody to do it because one department does something a certain way, and maybe it's a better or more innovative way of doing something, but it's not shared with the whole organization. Okay, so in the rest of the chapter, it talks about a couple of other things. So last time we said profit center, that means you're responsible for two things, right? Revenues and costs. Revenue center, you're responsible for only one thing, so it's revenue. With a cost center, as the name suggests, you're only responsible for one thing, your costs. Right? And for an investment center, you're responsible for your revenues, your costs, and your investments. Okay, good. Anybody have any questions about this so far? Okay, let's talk about the DuPont equation. The DuPont equation refers to this whole equation here. Okay, so this whole equation here is the DuPont equation. So as we talked about last time, companies, whether they're product-driven or service-driven companies, whether they sell products or provide services to customers, have this model that they work with. Every company operates on this particular concept. So you have cash, right? So every company starts with cash and they're going to purchase inventory, right? If you have a service business, maybe they have less inventory or no inventory, but you start with cash. And if you sell a product, you have inventory. And if you sell the inventory, you're going to have sales revenue. And then if somebody owes you money, that's called an account receivable. And then when they pay you the money they owe you, it turns back into cash, right? So this is a profit wheel. Okay, so this is another, that's the other name for this. It's called a profit or cash wheel. Okay. And every company operates on this principle here. So what this means is that no matter what type of business you are, or no matter if you're Department A, Department B, or Department C, there's two ways to make money. One is to turn the wheel and have a lot of profit being generated. So every turn of the wheel generates a lot of profit or cash. We call that profit margin, right? So profit margin is measured by operating net income over sales revenue. So operating net income over sales revenue. So for example, if you have, let's say, $99 in operating income, and I made sales of, let's say, $100, then that means a couple things. It means, well, my sales are $100. My costs must have only been $1 because my income, my net operating income is $99. So I have very low expenses. I have a lot of profit. And if I make one transaction, if I turn the wheel once, then we can generate a lot of profit. In the chat, there's a question. It says, if no one owes you money, we can skip account receivable and go from sales revenue to cash. That's exactly right. Yeah. So we start with cash. And if we're a service business, then we can skip inventory because we don't have any. So we go to sales revenue. And if nobody owes us money and we just deal strictly with cash, then we can skip account receivable and go back to cash. Okay. All right. Okay. What's the other way to make money? Is to turn the wheel quickly, right? So we call that turnover, right? Or turning the wheel faster. Turnover is a formula. It's sales revenue divided by average operating assets. Okay? So let's pretend that I have $1 million in sales revenue. And let's say my assets are $10. It's obviously a ridiculous example, but to prove the point, operating assets, this is like the engine in your car. Okay, so when I took financial statement analysis in graduate school, the professor that I had said, operating assets, that's like the engine in your car. So if you have $10 in assets, you have an engine that's $10 in size. And then if you generate $1 million in sales, right, then that little engine is producing a lot of output. So you're turning the wheel very, very quickly. Okay, so we can express this profit wheel DuPont equation in terms of numbers or quantitatively by saying that every business is a money wheel or profit wheel, cash wheel, and how much money you make is a function of how much money comes out when you turn the wheel and how fast you turn the wheel. And we can figure that out in terms of numbers. Okay, good. All right, let's go over residual income, and then let's take a look at some problems. Okay, another way to figure out how well a department is doing is to compute residual income. Okay, so residual income is how much income you have, right? This is this part here. And then you subtract out the minimum amount of money you need to make, right? So the minimum you expect to make is your average operating assets times the minimum expected rate of return. In the example we did last time, we said, what happens if my net operating income is $1,000, right? And I have an engine or I have assets of $5,000. That's what I'm working with. And then I need to earn a minimum of 10%, right? So that would be 1,000, that's my operating income, minus $500, right? So that means my residual income, like my leftover, okay? So extra income is, in this case, it's $500. Okay? So 1,000 minus 500 is $500. Okay. All right, anybody have any questions on this? When I took accounting, I remember in some chapters, we just had lots of formulas. And formulas are good and bad, I think, because formulas are good because if you know the formula, you can figure out the answer. Sometimes it's bad because you have to memorize the formula. But in this class, since the exams are open note, open book, you can have the formulas in front of you when you take the test. Okay, let's take a look at some problems here. So I posted this file on Canvas. So if you don't have it handy, that's okay. You can just look here. Okay, so these are similar to the homework questions that you're going to have. So here we have this company. I'm not even going to try to pronounce that. It's a division of a major oil company, and they provide various services to operators of the North Slope oil field in Alaska. Okay, data concerning the most recent year appears below. Okay, so first of all, this part here as an accountant, I really won't care, right? I mean, it's nice as background, but as an accountant, you care more about the numbers, right? So this is the part that I care about. Okay, so their sales were 7.5 million. Their net operating income, right, was 600,000. Okay. My first question is, what is net operating income and how is that different than net income. Typically, this is sales revenue minus your cost of goods sold, and then minus your operating expenses. Okay, so really, it's just a minor notation here, but just note net operating income is computed slightly differently than net income, because net income is all of your revenue minus all of your costs. That's your net income. Net operating income is a little bit more specific, and it's sales revenue minus cost of goods sold minus operating expenses. Okay? And also you should know that there are some variations of net operating income. So that's why for this chapter, they'll just give you the net operating income and you can just use the amount. Okay. So also it says that we have average operating assets of $5 million. So assets, that's kind of like the engine that you have in a car, right? So more assets probably means like a bigger operation, bigger engine, and it can generally generate more profit, hopefully, right? So they want us to compute some metrics for this division. They want us to figure out the margin. Okay, so margin is also sometimes called the profit margin. Okay, so they just abbreviate it and call it margin. So we'll figure out the profit margin. That means if you turn the money wheel one time, how much profit comes out, right? Turnover means how fast are you turning the wheel, right? And then return on investment is simply the two things combined, like how much money you make each time you turn the wheel and how fast you're turning the wheel combined. Okay, this sounds like here. Okay. So let's figure out the answers to these different questions. Okay. So return on investment, let me say that return on investment is simply profit margin times your turnover. Okay. So for this particular question, when we figure out profit margin, that's the answer to number 1 here. When we figure out the turnover, that's the answer to number 2. Okay. And then if you take 1 and 2, like profit margin and turnover, combine them together, multiply them together, we call that return on investment. Okay. That's return on investment. Okay, so let's write down here, just so we know, return on investment. ROI is return on investment. Return on investment is net operating income, if you like formulas, divided by average operating assets. Okay. Okay. Why is that? Because ROI is profit margin times turnover. That means ROI is net income, net operating income over sales revenue times, what do you see here? Sales revenue over average operating assets. These two things cancel out. That's why ROI is simply net operating income divided by average operating assets. Okay, so that's the formula here. Okay. Okay, anybody have any questions about this so far? Okay, so let's go ahead and figure out the numbers here. This is pretty straightforward because you just have to give you the numbers. Net operating income is 600,000. Okay, so 600,000. Okay, and then that's divided by sales revenue, which is 7.5 million. Okay, so 7.5 million. And then let's figure out what that is. I think that's 0.08 or 8%. Okay. 0.08 or 8%. Okay. Okay, so Let's do the next part here. Let's do turnover. Turnover is sales revenue, which is 7.5 million. Okay, so 7.5 million. And then let's divide that by the average operating assets, which is 5 million. So all these numbers are given to me. Okay, so then for the bottom part, we're going to get 1.5. 1.5. Okay. Now, in terms of labeling, profit margin is always a percent. So it's 0.08, or you can say 8%. And so 8%. In terms of turnover, turnover is a multiplier. Turnover is times. So it's 1.5 times. Okay, so what this means is the following. For every dollar of sales you have 8 cents or 8% left over as your net operating income. So that's your profit. So that means you turn the wheel once and then you get 8% profit, 8% money that you make back. And then for turnover, turnover is usually expressed in terms of a year, right? Because it says here, this is the most recent year information. So in a year, you turn the wheel 1.5 times in a year. Is that a lot? Depends, right? So the question people ask is, oh, 8%, 1.5, is that good? It's hard to say because numbers are only good when you compare them to other numbers. Numbers only mean something if you compare them to other numbers. So you'd have to look at companies in the same industry and then figure out what is the average profit margin, what's the average turnover. If you have like a company you admire or a company you think is the best in your industry, then you may examine their profit margin and their turnover and then try to target your operations so that you kind of are doing what they're doing or doing better than they're doing. We call that benchmarking. Okay, so if I combine everything together, 8% and 1.5 times, we can see what we're going to get. We're going to get an answer that's a formula. So 8% times 1.5 is, return on investment is 12%, right? 12%, because it's 0.08 times 1.5, right? Or if you like, you can say 8%. Okay, either one is fine. Times 1.5 is 12%. Okay, so then the answers are easy. Profit margin is 8%. Okay, so 8% is your profit margin. Right. Turnover is 1.5. It says round your answer to 1 decimal place. Luckily, it already is to 1 decimal place. Okay, so 1.5 times. Okay. Don't put 1.5% because that would be completely wrong. It's 1.5 times. Okay. All right, and then return on investment, again, we already figured it out. So return on investment is simply going to be 12%. 12%. Okay. All right, good. Okay, so anybody have any questions on this? I have a question. What's the relationship between profit margin and turnover? Generally, is there a direct relationship? Like if one goes up, does the other go up? Or is it maybe like an inverse relationship? One goes up, the other goes down. It would be bad if one goes down and the other goes down. That would be like a company that's not doing well. But what's the relationship between profit margin and turnover? Anybody know? Can you type in the chat? What is the relationship between profit margin and turnover. Generally. Yep, the relationship is inverse. Okay, so generally, if one goes up, the other tends to go down. Okay, so generally, the relationship between profit margin and turnover is inverse. When one goes up, the other tends to go down. Not always, but usually that's the general relationship, right? If I try to increase my profit margin, that means that maybe I'm increasing my price. Okay, so that's oftentimes how people do that. I can increase my profit margin by using cheaper materials. I can reduce my cost, right? If you do those types of things, then people tend to buy less from you, especially if the price goes up. People say, oh, your product is too expensive. I'm not going to buy as much. So then the turnover tends to go down, right? If the turnover is very high, if people buy a lot from you, then oftentimes one way to do that is to have a very good price. If you have a very affordable price that people are willing to pay, then you're going to sell your products cheaper. So your profit margin is going to go down, but you're going to make up for it in volume. Your turnover is going to go up. Okay. All right. Any questions on this? Okay, let's take a look at the second problem here. Okay, so this is Juniper Designs Limited of Manchester, England, provides design services to residential developers. Last year, the company had a net operating income of $450,000 on sales of $1.8 million. The company's average operating assets for the year were $2 million. Remember, always think operating assets, that's like the how big of an engine they have in their car, right? Their machinery, what they're working with, right? It has a minimum required rate of return of 14%. What's the residual income? So residual income basically is how much money you make. So your net operating income minus how much, like the minimum you had to make, right? So we can express this as a formula. So if you like formulas, then we can say net operating income minus average operating assets times the minimum required rate of return. Okay, so it's just a formula that you can use, and you can plug everything into the formula to get the answer. Okay, so then this is just plug and play, they say sometimes. Okay, so net operating income is 450,000 minus, okay, operating assets. So we're going to figure out the operating assets next, which is $2 million. Okay, $2 million. Okay, times what's the minimum they have to make? It's 14%. 14%. Okay. Now I kind of hesitated because where do we use this 1.8 million? We actually don't. Right? Okay, so if you do the math here, you're going to get 170,000. This is your residual income. Okay. Residual income. Now, with this information, you could also compute the DuPont equation, right? You could also figure out profit margin and turnover, right? Now, note that we have two different tools that we use for this chapter for responsibility accounting. We have the DuPont equation, Right? That's what we did up here. And then we also have residual income. The difference between the two is that up here for return on investment, DuPont equation, profit margin, turnover, all those different concepts and things that we figure out, these are in percent terms or times, right? So this is typically effective to use because you can compare different size organizations against each other. Because if I say my profit margin is 8%, then 8% means I can compare a small company to a very large company, right? Because it's in percentage terms, right? So when you compare things that are not really the same, percentages are a good way to make a comparison. You can say, I improved my my score by 4%. You improved your score by 16%. You automatically can make a comparison with the two things. Right? Here we have in dollars, right? Residual income is in dollars. So dollars is a little bit trickier because if you have a big organization, their residual income is probably going to be more dollars compared to a very small organization. But maybe the small organization is conducting their business more efficiently, right? So if you look at dollars, you can make a comparison, but you have to be very careful, right? Okay, does anybody have any questions on this? Okay, I have a question. Let's compute the DuPont equation. So in other words, I want you to tell me three things: profit margin, turnover, and ROI. So go ahead and do that for this particular problem. And then let's see what we get as the answer. Again, this is if you know the formulas, then it's easy to do. So I'll give you a few minutes to do this. I'll put the answer on the screen. We'll type it out together, and then we'll move on to the next thing. Okay, let's go over the answer here. This is a good opportunity to memorize the formula. Okay, so return on investment equals, and we can look up here if we need to, right? Profit margin times turnover. Okay, so profit margin times turnover. Profit margin times turnover. Okay, so then ROI, profit margin is net operating income divided by sales revenue. Sales revenue. That's all right. Times turnover is sales revenue divided by average operating assets. Okay. And where did I get this formula from? Just from what we just did above. Right? So right here. Okay, so let's go ahead and fill in the numbers. Okay, and then we have somebody that did it in the chat. Okay, good. Okay. All right, so thank you. Let me put this in here also, so we have it in the notes. But thank you. That's good. 450,000. Okay, divided by sales revenue is 1.8 million. Okay, times 1.8 million divided by average operating assets, 2 million. Okay, so then 25%, right? Or you can say 25% times 0.9. Okay, I don't know what company this is, but 25% sounds pretty good. Usually in the double digits, it's pretty good. We'd have to figure out what the industry average is. Turnover is 0.9. That's not even one time. It's like 90% of one time. So overall, they have a return on investment of 22.5%. Okay, 22.5%. Okay, so these are the different numbers. Okay, anybody have any questions on this? Okay, let's go back to the notes, and then I'll talk about one last thing. So back on the notes. Okay, last thing is transfer pricing. This is just something theoretical that you need to know. So transfer pricing is based on this particular problem. Okay, when two divisions in the same company do business with one another, how do we set a minimum selling price? That's the question. Okay, so for example, I gave the example of a family, like I have a sister. So if my sister wants to buy something from me, what would be a fair price? I don't want to set a price that's so low that it's not fair for me. And I don't want to set a price that's too high that, you know, it's better for her to go out and buy it from Costco or someplace else, right? So we have to kind of meet in the middle. And how do we set a minimum selling price so that it's better or good for the overall organization? In other words, how do we promote goal congruence? This term again, goal congruence. This means, how do I set a selling price so that if I do what's good for me and the other person does what's good for them, it's also good for the whole organization? Okay, so the rule that you use is variable cost plus opportunity cost. Okay, so I have to explain what this means. We have two different scenarios. We have a scenario where you have excess capacity, and you have a scenario with no excess capacity. Okay, so this is what you have to start with first. Excess capacity means I can produce more without sacrificing sales to outside parties. Okay, excess capacity means, oh, I have some extra time. You want to buy from me? Sure, I can sell you some units, no problem. No excess capacity means I can produce more, but I can't sell to anyone else. So for example, no excess capacity. Oh, you want to buy something from me? Okay, but that means I can't sell it to my regular customers. I have to sell it to you instead. So obviously, if you have no excess capacity, you're willing to accept a lower price because you're bored, you're not doing anything, right? So in this case, we say the minimum cost should be simply the variable cost. So the minimum cost is the variable cost. In this case, we say that opportunity cost does not exist. Okay, so it's just your variable cost. If you have no excess capacity, opportunity cost does in fact exist. Opportunity cost means, what am I giving up? Well, if I sell something to you, I'm giving up sales that I could have from other people. So then this is opportunity cost plus, I'm sorry, variable cost plus opportunity cost. Okay, so this is the general rule, and we have to modify this rule depending on the situation. If you are bored and somebody in your company or family wants to buy something, then you don't have an opportunity cost. Then the lowest price you'll accept is just your variable cost. If you are going to sell to somebody in the same company and there is no excess capacity, I'm very busy right now. I could sell you something, but then I'd have to take away from sales that I would make to somebody else. Then I expect to get more money, right? That's my minimum is going to be higher because I'm busy. Then it's going to be variable cost plus the opportunity cost. Okay, is this conceptually okay for everybody so far? Without an example, I think it doesn't make complete sense, but sort of okay. You give me a thumbs up if this somehow makes sense. Okay, nobody has their thumb up? Okay, all right, I'll explain it again then. Okay, so if I'm going to sell to somebody in the same family, what's the lowest price I'll accept? Depends on how busy I am, right? So if, for example, I don't know, Lily comes to me and says, oh, can I buy some of your cookies? Like I make cookies and I sell them. I don't really, but that's an example. Well, okay, I want to help out Lily, so I'll sell her some of my cookies, but it depends on how busy I am. If you're very busy, okay, if you're very busy, then you're probably going to sell it for a higher price. If you're not very busy, you'll sell it for a lower price. Okay, that's the first thing. If you are not very busy, what's the absolute lowest price you'll accept? Just what it costs for me to make the product. Just give me that. That's variable cost. If I'm very busy, what's the lowest price I'll accept? Give me like the cost that I have to produce the product, variable cost. Plus you have to give me like what I'm missing out on because I can't sell it to somebody else. Right? So this is going to be the minimum price with no excess capacity. Okay, let's try an example here. Let's say that my normal selling price is $120. Variable cost per unit is $55, and fixed cost is $20,000. Okay. What is the minimum transfer price if you have What is the minimum transfer price? If you have excess capacity, what is the minimum transfer price? No excess capacity. Okay, so I'll give you a chance to write this down if you'd like, and then we'll go over the answer. Okay, I have a question. What does excess capacity mean? Can somebody type in the chat what they think excess capacity means? What it does excess, in your own words, capacity mean? Anybody know what excess capacity means? Okay, good. Good, Molly. No opportunity cost. Very good. Okay, okay. Everybody sounds like an accountant here. Okay, I'm actually very impressed. What does it mean when there's excess capacity? There is no opportunity cost. There is only variable cost. It means you are not too busy. You have extra time, right? That's excess capacity. Okay, so you want to buy product from me and you're in the same family or the same company, right? What is the minimum transfer price? What's the lowest I'll accept? Well, how much does it cost for me to make this product? $55. So you have to pay me $55. I mean, if I can get a little bit more, that would be nice, but this is the absolute lowest, the floor, the minimum that I can accept. I have to get at least that much. Okay. Is that okay for everybody? Okay. What is no excess capacity mean? What does that mean, no excess capacity? But in just simple terms. Anybody know what that means? No excess capacity? Can you help me? No, I have no excess capacity. What does that mean? No excess capacity. Okay, good, Molly. I'm busy. I really don't have time to do this. I'm already selling all of the stuff I make, and now you want to buy some stuff from me. So what's the absolute minimum you have to give me? You have to give me a little bit extra. I'm not going to take $55, right? I'm going to take, what's the rule say? Variable cost plus opportunity cost. Okay, so here's how this works. You have to pay me $55. Everybody see here? You have to pay me $55 because that's what it costs me to make the thing. Plus, I can't sell to outside people now because I'm selling to you. Okay, I can't sell to outside people, so outside people will give me $120. And it does cost me $55 to make the product. So you have to give me $55 plus what I'm missing out on. That's called the opportunity cost. Opportunity cost means what are you missing out on, right? So you have to give me $55 plus what I would have made if I sold it to other people, because I can't, because I'm selling it to you. So that means you have to give me $120. Good, Molly, $120. Okay, can I get, will I accept more than that? Yeah, but this is the absolute minimum that I'll accept, right? This is called the transfer price. Transfer price means within the same company, right? Transfer price gets really complicated because if we have different divisions in different countries and the tax rate is different, then that also affects the transfer price too, right? So that would also have to be factored in as an opportunity cost. Now, if I'm selling to somebody outside the organization, then these rules don't exist because you just charge as much as people are willing to pay. Okay, remember last time we said that transfer price is between two people in the same company. Okay? So transfer price between departments in the same company. Okay. And the minimum is going to be determined by the person doing the selling. The seller determines the absolute minimum that they'll accept. What's the rule? We just talked about it. It's right here. Okay. And then the maximum that somebody is going to pay is determined by the person who's doing the buying, right? That makes sense in real life too. If you go to a store to buy something, who sets the absolute like lowest price? It's the store itself, the person doing the selling. If you're going to go to a store to buy something, who sets the absolute maximum that that somebody's going to be willing to pay? It's the person that's doing the buying, okay, the buyer. Okay, good. Anybody have any questions on this chapter? No questions? Okay, the homework is pretty easy. Okay, so the homework, we basically did it together. If you have no questions, I'll dismiss you early, but I do want to stay until 5:20 because I think it's a good chance for people to ask questions and stick around.